Rich Warner from the Smart Investor Models YouTube channel. Glad you could be with me again today. You know, it's tax season, and I thought it'd be a very good idea if we talked about tax loss harvesting. This is kind of a nebulous subject for many traders and investors. And in this video, I'm going to show you how you can harness the power of tax loss harvesting, whether you're a short-term active trader or a long-term passive investor, to save a lot of money on capital gains taxes. First of all, let's take a moment to review the mandatory disclaimer. You know, most investors see red in their portfolio as a sign of failure. Smart investors see it as a tax-saving asset. What is tax loss harvesting? Tax loss harvesting is selling securities at a loss to offset gains and thereby reduce taxes on future capital gains, short-term and long-term capital gains, as well as ordinary income. Tax loss harvesting, or TLH for short, is applicable, indeed very relevant, to short-term active traders as well as long-term passive investors. You're putting all those bad trades that you've made to good use. And many of you out there may be thinking, oh, well, what is it going to do for me? Only save $3,000 a year off of my ordinary income. And that's only a fragment of the story. I'm going to show you how you can build a cumulative tax bank for all the losses that you've incurred over years past that carry over into the future and that can be used to offset future capital gains. The trick is that you have to keep track of all your losing trades along the way. And if you have the right tools, and I'm going to show you how to do this in this and subsequent videos, to avoid what is called the 30-day wash sale rule, you'll end up viewing losses from a completely different perspective and may even give you some more courage to make trades and investments in the future. In the end, losses aren't so bad at all. Now keep in mind, TLH, or tax loss harvesting, is only applicable to taxable brokerage accounts. It does not deal at all with qualified accounts like Roth IRAs, 401ks, SEP IRAs, etc. But if you're like most investors and traders, you end up making quite a few losses along the way, and these accumulate over the years. So I was preparing my taxes a few years ago, and I noticed on my brokerage statement from one of my brokerage firms that I had accumulated thousands of dollars in short-term capital losses primarily, and that over 90% of these losses were disallowed because I was getting back into the securities that I had taken losses in within a 30-day window from the date of sale. That is, let's say I sold SPY for a loss in the middle of March, and I would maybe get back in 2 days later or 3 or 4 days later, what have you. And because I got in too soon, the IRS requires that you sit out for 30 days before you get back into the same security or a similar security. I kept doing this without knowing about the wash sale rule. And the net result was that I ended up disallowing over 90% of the capital losses, primarily short-term, that could have offset gains for that given year. Nor was I aware of the fact that I could carry over these losses into future years if I did not use them up to offset capital gains in any given year. So that was a big eye-opener for me. And I ended up studying and reviewing all I could about the wash sale rule and tax loss harvesting, and how it can be harnessed for traders and investors. I even ended up designing my own app called the Wash Sale Guard app, and also a subset app called the Wash Sale Date Calculator. And I've been using it for quite a while, and it's really quite straightforward. Now, I've made these apps available to you as well, and you can try out the Wash Sale Date Calculator for free, which basically helps determine when you're eligible to get back into that same security that you took a loss in. And so it's a very helpful tool. That's available for free if you check out the link below this video. But the complete tax loss harvesting app that I designed is called the Wash Sale Guard app, and it actually incorporates not only the date calendar, but also helps you keep track of all the trades that you took losses in from your brokerage accounts. You can assimilate them from any taxable brokerage account, and it records the date of sale, how much you lost, and it automatically suggests similar proxy ETFs or stocks that you can use to get back into immediately after you take a loss in a particular security. So I call this the master proxy list, and it's really quite extensive. And the app is really great because it'll actually suggest the ones that you can choose from. Let's say you took a loss in SPY. Well, one thing you can't do is get back into a similar security. So IVV or VU would be off limits. But that doesn't necessarily mean that you can't get back into something like SPY-G or SPY-V, which is the SPY growth ETF, or the SPY value, or SPLV, the low volatility SPY, or even another security like DIA, the diamonds, or even a leverage SPY would apply. So UPRO, UPRO, you could use that as a proxy if you took a loss in SPY, for example. So you wouldn't be able to get back into something like VU or IVV or SPY-M, but you could get back into one of those other ETFs that I mentioned. And surely you could get back into something like QQQ or IWM or VTI if you wanted to. The IRS just doesn't want you to get back into a very similar security. And the Wash Sale Guard app, the way it works is that it'll actually clean up the list for you as well. It'll archive those securities that have already been cleaned, quote unquote, and can be archived into another part of the spreadsheet where it tracks and archives all your losses for a given calendar year, for example. And that's important in being aware of how much carry forward tax bank you have. So the Wash Sale Guard app really does quite a bit for you, and it's available at a fraction of the cost of other competing apps out there that charge you quite a bit, and it's not even like real time either. The advantage of the Wash Sale Guard app is that it's as real time as you want it to be. I mean, as soon as you realize a loss in a security, all you have to do is double check the closed positions on your live brokerage screens and aggregate them into the first spreadsheet. So you could update it on the fly in real time, even during market hours, if you check your closed positions during market hours. And again, the link for this app will appear below this video. It's also available on the SmartInvestorModels.com website if you'd like. Okay, so there's certain things that you got to know when it comes to tax loss harvesting, TLH. Let's go over some of the mechanics first of all. Short-term capital gains and losses are when you exit a trade within a year's holding period. So let's say I bought AGG on December 30th, 2024, and I sold it on January 3rd, 2026. Well, over a year had passed since I first bought AGG in this example, and so if I took a loss on AGG in a taxable brokerage account, this would qualify as a long-term capital loss. And the amount of that loss can be used to offset other long-term capital gains. Furthermore, any of those gains that I made, long-term gains on positions that I held for over a year, will be taxed at an IRS favorable tax rate. For example, you are single and your taxable income is less than $50,000 per year, and you realized a long-term gain on a position, you will be taxed 0% on that gain. However, if you make more than $50,000 and up to $550,000, you will be taxed at 15% for any long-term capital gains. And if you happen to make more than $550,000 about, you'll be taxed at 20% of the long-term capital gains. Now, when it comes to short-term capital gains, you are taxed at your ordinary income tax rate or bracket. And these are for gains that are realized for holding periods less than 1 year. And while we're talking about tax loss harvesting, not gains per se in this video, understanding how short and long-term capital gains works is important as well. But when it comes to TLH, we're dealing only with realized losses, whether short-term or long-term, in taxable accounts only. One thing you should be aware of is that if you're a short-term active trader, or if you have certain accounts that you trade actively, the more active you are, the more useful tax loss harvesting actually becomes. And this should be clear when you consider the fact that short-term traders, or even to one extreme would be day traders, they're taking losses all the time, and these can add up significantly. Now, if you happen to be a very active trader and spend more than 4 hours a day on trading and or researching your trade, and you're like committed to trading as your main business, you can apply for something known as Trader Tax Status, TTS for short, 475F eligibility. And I'll go into this in another video, but suffice it to say for now that this is a particular election that you can make that will do away with wash sale rules altogether, and you can use losses that you make that accumulate in your account for any given year to offset ordinary income, not capital gains. And there's a limit to how much of those gains can be offset. It's actually 80%. But I'll go into details about Section 475F eligibility or mark-to-market eligibility in another video. So if trading is not necessarily your thing, but you're more of a swing trader, let's say, a position trader, which is a form of active trading, by the way, or if you're a passive investor, then tax loss harvesting can be very useful to you as a tax saving strategy. The good news is that even if, let's say, you have a ton of short-term capital losses, after they've been used to offset short-term capital gains, they can also be used to offset long-term capital gains. So it's not like, oh, I've realized a short-term capital gain, and it can only be used to offset short-term capital gains. That's not true. And the reverse is also true. You can use any excess from either category to offset the remainder. All the IRS is saying is that you must offset the short-term gains with short-term losses first, and if there's anything left over, you can use that to offset long-term capital gains. The reverse is also true. Just remember that it's a way for the IRS to keep things organized. Now, as mentioned, these losses, whether short or long-term, aggregate or accumulate over time in, let's call it, a tax bank. If your capital losses exceed your capital gains, short and or long-term, you can use up to $3,000 to offset ordinary income, but only $3,000. I think the main power or thrust of TLH is in the tax bank carry forward that accumulates over time. So you could accumulate, tens of thousands of dollars in realized losses over a decade, say, and you could use whatever's left over that you haven't used to offset gains during that period to carry forward into the future. So we're talking about a potentially powerful thing, especially when you're realizing gains, let's say, on positions that you've held, let's say stock growth funds. And then later on, when you're a senior, when you want to scale down your positions and take profits, you can use that cumulative carry forward tax bank to help offset the gains from those hugely profitable positions. Just keep in mind, again, this is only for taxable brokerage accounts. It does not apply to Roth IRAs, 401ks, etc. Now, one of the things you should really become familiar with if you want to explore tax loss harvesting is the wash sale rule. This is a 61-day window, actually. It's not just the 30 days after you realize a loss in a position in a taxable account. It actually includes 30 days prior to when you realize that loss. And the reason why there's a 61-day window instead of just a 30-day from the time of exit is that the IRS doesn't want you to double up on a position. And so there's a lot of FIFO, LIFO type of issues that come into play when it comes to this wash sale window. And you really could spend a lot of time trying to figure out which lots of a position should be offset with a realized loss, but that can drive anyone nuts. What I find is easiest for me, what I prefer to do is when I realize a loss in a taxable account in a particular security, let's say QQQ, I get out across the board in every single account that I own. I don't try to bother figuring out which lot it was that I should offset and all of that. I just say, you know what? If I don't like QQQ here, I'm getting out, and I'm going to get out everywhere. And then what I do is I enter that security in my Wash Sale Guard app in the spreadsheet. On that particular day, I say, okay, I exited QQQ. I took a loss of whatever, $1,500 or $1,000, whatever it is. Then the Wash Sale Guard app is going to tell you that, okay, you've got a 30-day window in which you cannot re-enter QQQ. And the app is going to suggest a series of proxy ETFs that you can use as a replacement if I should want to get back into tech stocks, for example. And by the way, it could be a leveraged form of QQQ. The IRS, surprisingly, permits you to get back into a leveraged form of QQQ, even though it's pretty much the same deal. So go figure. Anyway, so the app will suggest 5 proxy ETFs that you can use to get back in if you want to re-enter, in this example, tech stocks. Now, as mentioned, tax loss harvesting can really benefit long-term passive investors as well, particularly when it comes to rebalancing. So you're probably aware that you should rebalance your asset allocation, your portfolio, at least once a year. And when you rebalance positions back to their original weightings that you started out with at the beginning of the year, say, you may notice that certain positions have grown substantially and need to be cut back. So let's say your original allocation to XYZ stock ETF has grown from 15 to 21% of your overall portfolio, and you need to cut it back down. You can shave off 6% of your allocation and take a capital gain. Now, whether it's over a year, that would be a long-term capital gain. If it's less than a year of holding period, then it'll be a short-term capital gain. But what about other positions? Like, let's say, for example, you had some losing positions. So let's say your allocation to a biotech stock or a biotech ETF collapsed from the time that you purchased it, and the original allocation was, let's say, 5% of your portfolio, and it's only 1% of your portfolio now. Well, obviously, in this instance, you're going to realize a loss. Now, this is where tax loss harvesting comes into play, whether it be a short-term capital loss or a long-term capital loss. You're going to be able to use that loss as long as you don't re-enter that particular biotech security. Let's say it was XBI, for example's sake. Well, just make sure that you don't get back into XBI within the 30-day period. You can find proxies out there to get you back to the 5% allocation if so desired. Okay, so that's all I had to say for now about tax loss harvesting. I'll be producing subsequent videos that are going to show you different case studies of how tax loss harvesting can work for you. And also, I will be making a video about how to use the Wash Sale Guard app in practice. I'm going to be using one from Interactive Brokers and one from Fidelity. And I'm going to show you how I actually take the information from the screens live in real time and input it into the Wash Sale Guard app. If you'd like to explore the wash sale date calculator in the meantime, there's a link for that below in the description box, as well as a link for the Wash Sale Guard app. if you're interested. So that's all I had to say for now. This is Rich Warner from Smart Investor Models. I'll see you in the next video.